And I said they could probably close lower on the day. They did, kind of mixed, but it was pretty wild, but still pretty light volume. Now, we didn't expect a lot of volume. Just because the calendar turns and it's a new year doesn't mean that everybody's coming flooding back in on Friday, because of the holiday. More people are off. So we'll see. The more story will be told, um, the next couple of weeks. But basically, you look at the markets, we're just really consolidating. Uh, Everything but the NASDAQ had made a new high since we were last together. Um, again, what does it mean? I don't know. Look, it's quiet. There's not a lot to do. Market's default is to go higher as a rule, right? Aloha. So it's awfully early in Hawaii. What is it? 2:35 there? You must be just going to bed. Anyways, um, so look, we don't predict. We just look at the tape and look at the action, and we set up positions that are relatively neutral. I mean, our positions are fine. Um, Everything's in good shape, and the good news is we get to carry some losses forward after taking the profits. So last year, but it was an okay week, in general. Look, at the end, we didn't have a lot on. We have what we've been doing, and we'll see what the markets bring us. I mean, we're more dependent. Oh, still spring, got it. We're still dependent on action. Okay, now we don't take big sides or big positions. We let the markets make our decisions and make big positions for us, right? Does everybody get that? We let the market make the decision of what direction we want. We don't make the decision. We don't take a side when we put on a trade, at least the trades we've been using recently. Is that correct? Does everybody get that? Hello? Does everybody get that? Yeah, thank you. Happy year to you. Okay. Again, so we're not predicting the markets to go up or down. We're looking for movement or no movement. That's going to be the thing we're going to cover mostly today. That's how you design those and what you're looking for when you do that. But the markets themselves are, again, there's not a lot to do. Okay. No matter what, there's not a lot to do. Okay. Now, certainly I could make a case that we can go down from here. I could make the opposite case, but the chart itself indicates there's a greater probability that it goes down from here, and that's in the Russell, for example. But that doesn't mean it's going to. One of the biggest things we're missing is action. Good morning, Venezuela, free Maduro. Yeah, listen, between Chavez and Maduro, they destroyed a country. Okay, that's one of the few countries that could have actually had socialism that would have worked. Okay, but of course they stole all the money, so it couldn't work. But that's one of the few countries in the world that could have actually instituted real socialism, and their oil was enough to feed everybody. But of course, we all know leaders and politicians, right? They don't give a shit about nobody. But anyways, so we'll see. I mean, yesterday was just kind of a mixed, wild kind of day, back and forth, but again, thin, not a dramatic amount of action. And where are you? You're really just stuck, like in a NASDAQ, you're really stuck from, let's say, 25,000 to 26,000. Okay. You know, I mean, if you go back, how much action have you really had? We get too caught up in the size of the numbers when it's really what is the percentage move? Okay. I mean, I've always used this example, but if you had $100 stock that made a 2% move, so up or down $2, would you think about it? Probably not. Okay, so why do you think about it when the NASDAQ moves 2%, which is $500? I mean, again, everything's been percentage. Meantime, our positions are fine. We're in good shape. In the meantime, the markets are still going higher. I mean, we're not going to say they're not going to go higher. We just finished the third consecutive year of double-digit gains. So if you're hedged, you're having a hell of a good time. And the it's only once in history before has it happened 4 years in a row. Okay, I don't think this will be the year. I think there's a lot of issues that are out there. Uh, let's just look what's going on in that fucking Minnesota hellhole. Do you imagine that? And you know who installed all that shit in Minnesota, right? You know who originated all that, don't you? Don't even know. I think I've asked this before, but any of you know who instilled all that stuff in Minnesota to begin with? With the Samoans? Barack Obama, correct. I mean, I don't know. We wonder why things are in trouble here. Okay. Don't you think our politicians are a little bit too fucked up? So, anyways, so in the meantime, this won't end well. Well, again, at some point there'll be a nasty sell-off. This is not new. This is not news. It shouldn't be a surprise to anybody. The bottom line is what I always tell you. Okay. No matter what I think today, longer term, you need to be long the market and hedge the market. That has to be your core position. No matter what else you do, you need to be long the market and hedged. That's the simplest solution to everything that you do. It makes everything you do all that much easier to deal with. Does that make sense? I mean, if the bulk of your estate is hedged, then you don't have to worry about it. So it allows you to make other types of trades that, yes, you can make a much bigger percentage, but if you don't, you have your core of your assets. Okay. That's the whole deal. Thanks for the hedging. You're welcome. Okay. That's the whole deal. Okay. If you're protecting, let's say, 80% of your estate, whatever number that happens to be, you can play with the other 20% because you're not picking a direction of the market. You're not saying, well, this guy said it's going down. But listen, you got guys got guys that make cases for each side. I don't make a case for any side. Statistically, the markets are going higher. Whether they go higher this year, I don't know. Okay, I wouldn't think so, but that doesn't matter. I'm not gonna liquidate what I have because I don't think we can go higher. I'm gonna accumulate more. The 1960s, oil gone in 10 years. 1970s, another ice age in 10 years. 1980s, acid rain will destroy all crops in 10 years. 1990s, the ozone layer will be gone in 10 years. In 2000, ice caps will be gone in 10 years. None happened, but it all resulted in more taxes. Aren't we lucky? Okay. We get to pay more taxes. And aren't you sick of paying all these ridiculous taxes? As a kid, I watched The Wizard of Oz and wondered why anyone could talk without a brain. Then I discovered social media. Oh, man. Anyways, now here's a perfect example of what's wrong in this country. Kathy Hochul caves on no tax on tips. I mean, was that not the deal anyways? I mean, does anybody here think that we are taxed not enough? We should be paying more taxes? Does anybody here say, seriously, this is a serious question. Or do you think we're overtaxed? Now, certainly if you live in New York or Chicago or California, you're for sure overtaxed. But isn't it amazing, okay, that we pay all this taxes. You pay property tax for land that you own, okay? You pay all these taxes, okay? And what do you get for it? Nothing. More debt, more rich politicians. So, I mean, they want to screw the taxpayer. I don't understand it. DOJ eyes Minnesota's vouching system for voter registration demands records. I didn't know about this. Did you guys know about this? That in Minnesota you can vouch for somebody? I did not know that. I almost fell off my chair when I read it. Okay. I can vouch for you. I can vouch for up to 8 individuals to vote. Now, I can't vouch for you to get on an airplane. I can't vouch for you to get into a bar, but I can vouch for you to vote. The more important of the things. Push for censorship on Kansas hits record levels in 2025. I tell you, our whole system, our whole education system, we have destroyed education. We teach our kids nothing. Okay. We teach them how to bury their heads behind a phone, behind a computer. No social skills. Pretty sad when you think about it. Okay. Social Security will be insolvent in 6 years. What's Congress going to do? What are they going to do? And that is a fact. That's not hyperbole. That is a fact. It will be busted in 6 years, but of course, obviously, they'll fix it. But what are they going to do about it? So what does that mean? Does that mean higher FICA tax? Does that mean higher income tax? Does that mean they're going to finally get smart and stretch out the age? I mean, wouldn't it be better for everybody except for the government if there was no Social Security, but yet there was a mandatory fund that you had to pay into that you had control over, but you could not withdraw until you were 65? Wouldn't it be better, something like that be better? Or 70, whatever the age would be? Wouldn't we all have a lot more money if we took our did we attack Venezuela? We took care of Maduro. Wouldn't it be better if we paid all that money in? I mean, I paid the max every year since I've been working. So whatever that comes out to be. Wouldn't I have more money and get more money if it was in my own account? Okay. But anyways, they'll do something, but you know who's going to pay for it, right? Fed minutes show concerns over upside risk to inflation, downside to jobs. Well, gee, shocking when, again, some of you may have made a lot of money in the AI stocks and Nvidia and all those other stuff, but at the end, that AI is costing you more for electricity. It is destroying jobs. It's going to lead to universal basic income. So all of this stuff, okay, will not create a pretty ending. Okay. Anyways, hold on one second. Hold on one second. Okay. So there was a question posed. Recall my issue with my IWM. I have no spread, just 100 short shares at 238 from the assignment, a 241 long call, and 231, two short, 230 puts. Okay. Well, it should be two long 230 puts, but either way, okay. The stock, okay, is covered up by the call. So what is that design? If the stock is covered up by a call, what is that? What is another name for that? Synthetic put. Look at how you've been paying attention. God, you are right on top of it awfully early for you today. You're spot on today, baby. Anyways, and the 230 puts expired worthless. Okay. In your 230 puts, where are your long puts that are in January 16th? Okay, that I don't know. Okay. Where are the long puts January 16th? Okay. But either way, in this position, your net flat to long to short. Okay, your net flat to short because the 230 puts are basically worthless, right? If we forget that there's longs, which it can't be because there's no way you get out of the longs. But if you did, okay. I mean, I can't say no way, but if you did, that's okay. But at the end of the day, the stock's at 248. The 230 puts are worthless. Okay, and you should be selling them every day. Okay, but you have on basically a synthetic put. Okay. Now you can cover the shares. You can roll up the long call. I mean, what I'd do if it were me is I'd roll up the long call. I'd roll the long call all the way up to, I would have rolled it up all the way to 255 when it was up there. But right now I'd roll it up to 250. I'd make that a short position. And not because I'm negative or bearish, but because it doesn't cost me much to make it a bigger short and gives me a chance to collect. Does that make sense? Gives me a chance to make money. Okay. Right here, I have a chance to make money, but basically, I'm just sitting here and holding stock. Okay. Holding long stock against holding short stock against a long call. So if I roll a long call up, I take some credit out and I can put myself in a better position. Does that make sense, everybody? You're late. You missed your favorite word 3 times already, so I can't do it anymore. Do we understand this? Again, nobody's answering me, so I don't know if I can move forward. I need to know if that makes sense. Okay. So again, there's a lot you can do if you happen to get assigned or you're carrying stock. The question you always ask yourself is, can you afford to carry this thing? Well, your fucking city, your state is fucked up anyways. There you go. We had a whole thing about your state. I may move there. I figure I get some money. Anyways, so you have the stock, you have the call, you have a synthetic put. So do you want to stay with a out of the money put, or do you want to create a more in the money put? Right? That's really what you're dealing with here. But there's no risk to the upside. Okay. Do we get that part? There is no risk to the upside. This stock can go to a billion. I have no more risk than I have today. No, my call profit would be one for one. 100 shares, one option. It's one for one. This is 100 shares and the long call. A 241 long call, assuming 100 shares. They equal each other, right? One equals the other. Is that right? Is that cool? Again, if you don't understand, look, we're starting a new year. We're going to learn more stuff this year. Okay, we're going to start building on what we already know. But you have to participate and let me know that you get what I'm giving you now so that I can move to the next step. Okay. But again, one call, one option, 100 shares of stock. If one's long and one's short, they cover each other up. Does that make sense? So I'm not at risk here. My risk is whatever I've already lost because this is probably at full value, 238 to 241. Okay. So I've got the 241 call. I got assigned to 238, whatever. So I'm holding a synthetic put at 241. The profit on the option isn't 100%. Well, it is. I mean, the option is direct here. Here, let's look at this one. Okay. IWM. We'll use the January 16th. Okay. I don't know which date it is, but okay. The 238, the stock is trading at 248. Okay. The option that I'm supposedly long is trading at 911 or $9. Okay. So I've already lost the $3 between 238 and 241. That's already priced into the market. Correct? So these are going to basically go up or down dollar for dollar right now. Okay. Yes, I know it's 80 deltas, but it's going to be dollar for dollar pretty much. Okay. Because a deep in the money call is virtually the same as the stock, right? So for all intents and purposes, this is a flat trade at this level. Okay. And the only way that it can make money, it won't lose anymore if it goes up. I mean, there's how much premium here. The way you can tell is what is the premium in the call. Okay. The stock is trading at 248.78. You're long the 241 call. What is the intrinsic value of that? What is the intrinsic value of the 241 call? That's okay. You're good. So the intrinsic value is almost $8, right? So there's a little bit of risk, but that premium is going to remain. So you can always wheel out of it. Okay. But if you rolled up, okay, and decided to, hey, I want to change this and I want to make this into a more of a short position, sell the 241 and buy, let's say, the 249. Okay, I could collect 564, but I am adding a couple of bucks risk into my position. Is that right? Does that make sense? But if I leave it, it's fine. Of course, again, I'm tying up capital with the stock with no benefit to the stock unless the market collapses. And if I think the market's going to collapse, wouldn't I be better rolling up the long call? Everybody clear on that? I mean, again, this is important, so I want you to make sure that we all got this. This is part of what we're going to start to learn. So I need some more yeses or nos. I need some more participation so I can make sure that we're in good shape. I think no, you're right. You have it right. Okay. Now you're not taking the money. Okay. All you're doing right now with this position, by the way, you just got here. I've already spent about 10 minutes on this question, but where are the long puts at? And how are you short the 230 puts? They're worthless. Okay. If you're short the 230 puts, they're worthless. What expiration are they shorted? Help me out here. Okay. No problem. I mean, I can't imagine you're short in January. It's January 16th. You should be long in January 16th. Some puts, but again, doesn't matter. Let's just figure it out. Part of the bigger answer. But anyways, anytime you have 100 shares long of stock or short of stock, either side, if you're short 100 shares and long a call, you have a synthetic put. If you're short 100 shares, if you're long 100 shares and have a long put, you are long a synthetic call. Yes, but you're not short the puts in the 16th. You're not short two puts to the 30s. You're long two puts, 230s. Is that correct? You can't be shorter. Oh, if you're short of me, you fucked up the entire trade. Thank you. Okay. So again, that's my point. Okay. So those are worthless. Okay. You have a position on now that you're short the stock, you're long the call, you have on a synthetic put, which has got no value. You cannot make any money the way this is designed with only one call to the upside. So your only potential way to make money on this trade now is to the downside. You follow that? Okay. So if you want to, you can either close it out the way it is and realize the gain or loss. It should be a gain, but gain or loss, whatever happened. Or you can say, you know what? I want to roll up that long call. I've created a synthetic put. Okay. I want to roll up that long call up to the 249, take a 564 credit, add to my risk of the trade $2.36. Okay. But if the markets do go down, then I get paid dollar for dollar on the way down. And now I have a trade. Now I'm not sitting on a trade that's just dead with nothing, with no potential action to go with it. But you should also be selling puts every day against this long put you own. Okay. And you can sell the 235s or the 234s every day for 3, 4, 5 cents. Doesn't matter what the number is. Okay. Take whatever it is. Take $8 a day, $10 a day. Does that make sense? Again, there's no reason not to take 8 to 10 to $20 a day. I mean, we've been doing that every day for months now, have we not? Has not everyone been collecting premium every day? And we talked about this at length of selling premium against your current positions every single day. Okay. So you're leaving money on the street. Go ahead. That's all right. We'll get to it. But in the meantime, for your specific question right now, what I would do if I had that position on exactly, I would roll up the long call to the 249 or wherever we open Monday, okay, and turn into a short position. There's not much risk, only a little risk to make a lot of money. Okay. And I would sell puts against the 230 puts that I'm on. Okay. We good? Let me know we're good so I can move on. Yeah, well, the trade's almost over. So there's no reason to get back on track. It's kind of what I'm going to cover today anyway. So you keep listening and then you tell me if you understand when we're done. because this is kind of where I'm headed today, anyways. These kind of situations. Okay, this is a little messier than most, but again, it's easily fixed. I just gave you the simple fix for what you currently have. Okay, that would be the simple fix. Or you can just hold it as is and hope for a breakdown in the next 2 weeks. And you got 2 weeks to go. What makes trading harder? I didn't yet understand that the problem wasn't the market. It was me, the operator behind the wheel. I was fighting uncertainty instead of learning how to live with it. I was trying to be right instead of trying to be consistent. I was looking for certainty in a place that can never provide it. How about that? Okay. Does that not make sense to everybody? Does not everybody do that? And do we not talk about this all the time about saying that the market's the market? You're never going to defeat the market if you think that you're smarter than the market, because you're not. Nobody is smarter than the market. Okay? The market is an inanimate object. Okay. So deal with what you have to deal with. And that means dealing with our positions. One of the reasons that we use the type of positions that we use is because we don't have to get emotional about what's going on. Now, those of you with me the longest, isn't it nice to put on a neutral trade and really only have some premium risk when it's all said and done? Yes, some of the debits are big, but when it's all said and done, do we not make money on 90% of our trades? Is that about accurate? About 90% we make money. Now, again, they're not all big wins, but when it's all said and done, we're always dressed for the party. We always hit the home run when they're available, and the rest of the time we're just grinding away. Right? Is that correct? According to my trade journal, yes. Well, that should be correct. It is correct. I mean, I don't say things. Not 96.3, maybe 90. I'm not as good as the airline pilots. Either one of them. I'm not as good as you either, Captain. But anyways, so again, remember that. Now, today, this is one of the new trades. Okay, we're going to put on the Qs. That's a big debit, 47.76. Okay. Now, everyone wants to know, how do you decide the trade? Where do you put them on? Why don't you do them directionally? I don't want to pick direct. You know what? You know what I learned? If I can put a trade that on that is relatively neutral, that will benefit from big movement either direction, why should I be the smart guy and try to figure out which way it's going to go? His name is Chuck. Up Chuck. Not Chuck Yeager, though. I mean, so again, so when I look at this trade, so how did I arrive at the strikes? Does anybody know how I arrived at these strikes here? This is a dead neutral trade. If you do the deltas, you'll find out it's pretty neutral. Does anybody know how I arrived at the strikes that I put here? No. Let's let's do some work and let's look at it. So if I look at the trade and I put up the Qs, okay. So because expected move. Okay, expected move on what time frame? There you go. You're on target. Expected move on what time frame? This is the key here. The expected move under what time frame? Okay, the monthly 21 days, the longs. Okay, I do it on the shorts. Okay, because my issue is the shorts. My collection is the shorts. My protection is the longs, right? So, and now again, this is not, well, there's only one way to do this. You can do it a number of different ways. Okay. But this is the way that I do it. So I look at the expected move, and I looked at the expected move for Tuesday. Okay. And I go, okay, so the expected move on Tuesday is about $6. Okay. Yeah, I know I got to change it. I put the I made the wrong trade. I got to change it. I have it right here. But anyways, so if I look at the expected move, okay, it's about $6. Okay. So I'm going to go up, okay, $6 to the 619. I'm going to go down $6 to the 607. And that is going to be where I'm going to sell my short options. Okay. And then I'm going to go out. In this case, we went out to February. Okay. Now in February, okay, I can go at the 621, which is where I chose to go. You can go farther away. You don't have to go only $2 wide. To me, it's just like a nice round number, depending on what you're trying to do. Okay. But let's say we did what I said. So how do I evaluate the trade? Okay. So if I'm going to collect, okay. Now my first collection is approximately 93 cents and $1.16. Right. So about let's say about $2, right? Does everybody see that? That strangle, the 619, 607 is about $2. Okay. Now, so then I asked the question, okay, how many days do I need to pay for this trade? All things being equal, okay, nothing changes. How many days do I need to pay for that trade? Okay, well, I have to look. Now I have to go back and do one more look. That would have been my first answer to 24, but that is incorrect. Okay, that was my first answer too. But what I really have to go back and look at right now is I have to go back and look at Monday. Okay, because really, remember, we're doing a 1 day roll, right? We're doing a 1 day roll, right? From once we get in on Tuesday, it's Tuesday to Wednesday, Wednesday to Thursday, Thursday to Friday. Okay. So I got to look at it and I go, okay, so what is the straddle for Monday? The initial is 1, but now what's my straddle for Monday? It's 90 cents. Well, so it just so happens that I wrote that out for you. Okay. So based on current pricing, how much should I collect every day? Based on the current market, right now it's 90 cents a day. Okay. Everybody follow that? Every day I should collect 90 cents. Okay. How many days do I have to expiration? Well, I believe there's like 49, I think. I forgot. I looked earlier, but I forgot. But anyways, we'll look at it right now. There's 48 days expiration, but of course, in that expiration, there is some holidays and there's some holidays and there is some weekends. So figure there's about 40 days to expiration. Is that about right? Why do we get in on Tuesday and not on Monday? Well, you can put it on Monday, but it's just easier because you're going to roll it right away from Monday to Tuesday. So it's just easier to start with Tuesday, and you get paid a little bit for going to Tuesday. It makes it easier to deal with, so people don't have to make a trade, especially if with day trading restrictions, all this shit. Okay. So 40 days, which is about right, correct? Am I right there at about 40 days? So 40 times 90 cents is $36, right? So I'm a little short to what I need, right? I'm a little short to what I need to collect, which means that I'm going to need, what am I going to need to happen if I'm going to put this trade on? What am I going to need to happen? So 40 days times 90 cents is $36. So what do I need to happen? For me to put this trade on and legitimately put it on, knowing that I may be putting on at a loss to begin with, if everything went flat and stoic for the next 40 days, I'd be actually working on a potential loss. So what are the things I need to happen, okay, to increase the factor? Sell daily premium, which we do, which is that's the 40 days times 90. Okay. Big moves, we need some bigger moves. Okay. And we can get big moves on either side. Okay. Plus the fact that we could also get a spike in volatility, right? Volatility is relatively low right now. Okay. So if we can get a volatility expansion, thank you. Okay. So all those factors, knowing that we're in the beginning of the year, knowing that we should see more volatility, okay, knowing that we could have a big move in either direction, I am willing to make that trade. Now, if you don't think so, then you don't have to make it. But this is the layout. Most of the trades that we will put on like this will self-finance. Does that make sense? Most of the trades will not be this far away. They will self-finance, everything being equal. Now, again, we all know that everything is not always equal, right? Obviously, in the Oracle trade, it should be close to profit or profitable. Everything depends on how you handle it. But at the end of the day, if we made the perfect trade, it would have been really profitable, but we didn't, or I didn't. Okay. But again, these are the factors when you're looking at this type of trade is your big question, which you'll see the slide as you see every week. What if? The big question is, how am I going to get out? What are my steps dealing with this? How do I get the average of 90 cents? Well, I don't know it to be 90 cents a day, but I do know that Monday's premium, okay, is 90 cents. Okay. So I assume that the roll from Friday to Monday was 90. So I'm going to assume the roll from Monday to Tuesday is 90. Tuesday to Wednesday is 90. Now, again, it can change, but that's the only number I have to work with right now. Does that make sense? Does that make sense to you? No, I need the person who asked the question. Let me know it makes sense. Does that make sense? How I got to 90? No, I don't think I think it's already cheap. But again, I only deal in raw numbers. Okay. I don't look at the other factors that can affect advantagely or adversely because I can only deal in raw. Okay. Because I can't tell you what's going to happen tomorrow. So I can only deal in the raw numbers. Okay. But if you want to haircut it, go ahead, haircut it. It's not a big deal. The real question is do you believe that the Qs can move enough in either direction or in the middle and enough volatility to get you out and make you a profit? I believe the answer is yes. So I'm willing to take this trade. But if you're not in agreement, then you shouldn't take it. But I think volatility is lower than it will be. Okay. I think I'll get more, but again, I don't want to presume that I'm going to get more. I want to just deal with the numbers I have in front of me today. And these are the numbers I have in front of me today, 90 cents. We already have the SPY on. I mean, I can do it again, but we already have it on right now. We do the indexes, anything that has dailies, we're always going to be carrying a position on those. We're carrying a position right now on the IWN, the SPY, and the diamonds, but don't have dailies. But we are carrying positions on those right now, are we not? So do I want to duplicate the position? I don't think so. I mean, again, this is a capital intensive business. I can put on as many positions as you want. How much money you want to tie up? I know, but you were here for the original when I put them on. I do remember that because you and I discussed it, right? You were here when those trades were put on. I know you are. That's okay. It's no big deal. Listen, they're going on next week anyways. Next week there'll be new trades you can bet next week. There'll be IWM, the following next Saturday, IWM SPY will be going on next week. We'll double them up for a week. Okay. So, anyways, is this clear to everybody of how you kind of do the calculation and figure it out? Any questions? Anybody? Okay. All right. Now, a couple of open positions. Now, your position will not look like mine at all. Okay. Your position won't look like mine at all. Okay. But this is my current SPY position from what we started with. This is where I'm at now. Okay. Now, there's things that come up, things that you change. Okay. My second GLD trade is doing well as, oh, it's doing very well. Yeah. Does your initial estimate of daily decay tend to be too high or too low? It tends to be exactly what it is at the time. I don't make an estimate. I look at the numbers as they are today. Again, I can't make assumptions. I can only look at what it is. Again, I deal in absolute numbers. I don't deal in anything else. Okay? I'm not interested in trying to figure it out. I deal in the absolute. Right now, the number from Friday to Monday is 90 cents. No matter what I think, it's 90 cents. That's the absolute. So whatever your position is, okay, now I'm sure many of you are not short the 690 call. Okay. I am because somehow I don't know how I ended up there, but somehow I ended up there. Shalom. Can we take into account selling premium for extra long options, zero T's, or are they irregular? Can we take into account selling premium for extra long options? I'm not sure. I'm not sure I understand your question. Yes, the case change over time. Give me a better, I'm not clear. Oh, in my calculation here? I mean, zero DTs are going to be what they are. Okay, they're going to change. There's going to be sometimes there's more. You've all noticed if we've made these trades, sometimes we're getting for the rolls, we're getting $1.50, sometimes we're getting 80 cents. They change every day. But you won't get much lesser of the decay than you're getting now. Your IV in the Qs is about as low as it's been in a long time. Is that not correct? I mean, your volatility is very low right now. I mean, look at your IV in this SPY. 12%, 10%. They ain't getting much lower than that. Would you agree or disagree? You mean buying a straight strangle? Yeah, 100% better. I would never buy a straight strangle. Buying premium is a losing way to trade, unless you're day trading it. Total cost will be lower if we sell extra premium for yes, but you're better off using the zero DTE if you can, if it's available. Remember, okay, the sum total of the daily option will always be greater than the sum total of the weekly option. The sum total of the weekly option will always be greater than the sum total of the monthly, and so on all the way back. So the shorter the time frame you can sell premium, the more you're collecting. Does that make sense? Does low IB indicate that the market could likely move up? Well, I mean that's what you assume, that the market is relatively calm and complacent. So you would assume that there's probably more upside coming. But of course, we've all seen that movie before. Again, I don't make predictions, but I do like to buy. I do like to buy premium when volatility is low, and I can stretch it out like I am. So I'm buying something out in the future that I'm financing in the short term. How do you know when you don't know? You pick a number and you roll it. I roll first thing in the morning. That's when I roll. I set my orders up when I get up in the morning. 2 o'clock in the morning, I set them up. But you can roll whenever you want. This you're talking about pennies versus dollars. Okay. If I wait, it's not going to be much more unless there's a drastic change in volatility during the day. Okay. So if I wait If let's say I'm getting 90, if I get 90 on the open, am I get 92, 93 if I wait? Is it worth it to wait? To me, it's not. Certainly, there's a lot of ways to navigate in and out of these things, but to me, the simplest way is just to roll them right away and get on to the next step. And typically, I will set up my rolls. Okay. And then once I get one rolled, I'll set the roll up for the next day at a dream price in case something else happens during the day. We all clear? Let me know. Okay. So adjusting is just this example. I mean, again, you can adjust wherever you want. It just, I just take what the current price is like right now. If I was going to work a dream price for the 90 cents, I'd put it in $1.10. Obviously, I won't have that much time, but if I put in 20%, 25% over what it's trading. That's all. Nothing, no magic. But you can adjust. Now, for example, I own the 650 puts here. Okay. Right? You can all see that? I own the 650 puts from part of this position. Everybody see that? How long do I typically hold the extra option? I don't, it depends. It's an unanswerable question. If we get movement that will take me out at a profit, then I'll liquidate the extra option and actually reverse the position. If it's still in question, I'm going to hold on to that extra option because I want the benefit of movement in that direction. It's not a question I can answer. The only time I for sure consider closing the extra option on either side is if I've locked in a profit on the trade. Everybody understand that? So, anyways, back to my original question. Everybody see that I'm long the two 650 puts, right? I always roll the extras. We roll them all the time. We roll them whenever we get a chance to take off money because every time you roll it, you're reducing your overall debit. Okay. But look at what put I'm short here. I'm short to 677. So I'm exposed, right? I mean, in theory, I'm basically just selling a naked put with protection $27 lower. But at the end of the day, I don't care because I don't foresee that much of a debacle. Okay. It would have to have a hell of a move. And I'm willing to take the chance because it's only one day at a time. It's not, I'm not holding it for 6 months. I'm holding it for less than 24 hours. Does that make sense? So when a trade gets away from you, there are ways to collect premium, which is what we're going to start working on throughout the year. The first thing we had to do is identify the process. And then we're going to start working on the adjustments. Clear with everybody? Got to help me out here. Again, I can't teach unless I know where we are. Okay. But there's a lot of adjustments we're going to start to make because we're going to talk about, the adjustments we make. And that is, again, we talked about this right before the break. Okay. Short strikes, long strikes. Again, we just talked about earlier today, we talked about the IWM rolling up the strike because of the way the position ended up playing out. Okay. But we can also make some adjustments internally once we get there, which will be, and again, we're going to work on a piece of this every week to try to build it out because, we can do more with our positions than we've done. But before I can do that, I have to make sure everybody has a solid understanding of what we're doing. Yeah, I've got 3 new trades this week. One you already saw, the Qs. Okay, I'm getting there. Okay. Remember, we can change the design of the trade. We regularly sell one short option nearest expiration versus 2 long options far expiration. If We regularly sell extra short options against our second long option. Shouldn't we take this money into our account? Yeah, you are. I don't want. I don't want to take it into account. That's something extra. That's extra money. That's not part of the trade. That's an extra bonus that you picked up. That I taught you how to collect premium on a daily and weekly basis. That's extra. That's a little bonus, but I don't count that in the overall picture. Remember, everything we do is neutral. We start off with a delta neutral position. Okay, that's where we start off with. What type of trader are you? That's you got to decide where do you want to go. Going back to the original IWM trade I talked about, you can sit there, which is worthless. If you're going to sit with the position you have, for example, you might as well just close it because you have no benefit. You keep the 230 puts because God forbid there could be a collapse in 2 weeks. They're worthless. You're not getting any money for those, but the stock and the long call, it's worthless. You're just tying up money for no reason. So it'd be just better to close it. Okay. And use that capital for something else. We sell premium every day against the positions that we have. Sell out of the money, puts or calls against the double diagonal we have on a daily basis. Not only do we do the rolls, but we sell some extra. And it adds up to, somewhere between, depending on how big you're trading, $100, $200 a week. Don't mistake possibilities for probabilities. Anything is possible. It's the probabilities that matter. Everything must be weighed in terms of likelihood and prioritized. Again, this is what we talk about all the time. The entire design of the trades is based on probability. No, they're never uncovered. We don't sell uncovered options, ever. I don't sell uncovered options, ever. But I do own two in January that I could sell against for a day. They're not naked. They're not uncovered. They're covered up by the January. Do we get the probability side of this thing? So when you go back and look at a trade like this, where I made some adjustments, okay, I know the probability. I'm 99.9% going to collect on this. Okay, I'm willing to take the risk. Okay. Now, again, to your point right now, on Monday, I'll probably sell, the 691 or 692. I have to look. I don't know yet, but I'll sell a call and I'll sell a put extra besides this that have already expired. Okay. As you can see here, there they are. They expired. I picked up $101 yesterday. Right there. Those were extras I sold. There it is. There's the proof. Okay. Again, you got to learn from every trade. You got to think through and walk through every trade. This is the best teaching of options, futures, and options planet, selling on the planet. Yes, it is. Thank you. You have to learn from everything you do. You have to walk it through. Okay. Don't take my word for it. Do the numbers yourself. I showed you how to do the calculation. Do the number yourself. If you don't believe me, do it. I would love it if somebody would do it. Listen, one of our biggest trades ever came from one of you. The trade on Oracle, the first one. That was somebody else's idea. It wasn't my idea. It was a great trade. Thank you. I'll thank you again. Again, remember, you always have to walk through your mind the what if scenario. What if I do this? What happens? Let's go back to this trade here. So if I do what I said I want to do and roll the call up to the 249, what if? What happens? Well, I've created a short position that I've added a couple $100 risk, but I'm willing to take the risk because I do think there's a chance the market will go down. I'm willing to make that adjustment. But I know that going in front before I do it. Know what you're doing before you do it. Does that make sense? Yeah. Our open positions, Oracle, it's okay. GameStop, I sold the extra put. It's going to be a small win. I mean, it still has a chance to be a big win, but I doubt it. It's really not moving very much. Chewy, everything's in good shape. Nothing is going to get hurt here. When do we sell the January 16 credit spread? What do you mean? I sell them every week. I don't have a January 16th. I have a January 9th now. And I'll roll to the 16th sometime this week, by Wednesday probably. I've already rolled it 5 times. The roll is over. I'm going to roll it from the 9th to the 16th, right? I'm going to roll from the 9th to the 16th. Sometime this week. There's no date that says you have to do it here. I like to have them done by Wednesday. Okay. That doesn't mean you have to have them done by Wednesday. I like to have them done. I'll set them up Monday. Okay. And I'd like to have them done by Wednesday, but there's no law that you have to have them done by Wednesday. Thursday's okay, Friday's okay. But I like to be done by Wednesday. It just depends on what's going on. You don't get it. I don't care about the assignment, but you don't get assigned typically because typically you don't get assigned till Wednesday or Thursday or Friday. We'll close out the trade next week. Right now, there's something to close out. It's profit. They're profitable. The question now is not if we're going to make a profit. The question is how much are we going to make, and we'll have to see how it plays out. Why should I make a decision now? When I have zero risk to the trade left, I've got a profit locked up. Why should I be in a hurry to get out now? Can you give me a reason why I want to be in a hurry to get out? When I have a guarantee win, the only question is how much? Don't I want to have the opportunity to play with it and kind of navigate around it? What do you think? I mean, now you're in the driver's seat. Okay. You get a big move to the upside, maybe you can sell off the extra calls and play for a move back to the downside. There's no reason for me to close it now. I got no risk. Why should I close it? What do you think? You're very intuitive. What's your take? Yeah, maybe. I might wait all the way to the 16th. Again, I don't know what the markets are going to do. And I'm not going to predict it. The only thing I know for sure is if we get a big move that is favorable to any one of these positions, I assure you we'll be closing part of it. Okay, not all, I'm never closing all of it because let's say we get a big move up in something, okay, and I sell the extra call. Well, if I get a big move up, there's probably a high probability that there'll be a little bit of a pullback. So if I liquidate the extra call and I do get the pullback, don't I get that chance to double dip and make money on both sides? Doesn't that give me an opportunity with no risk? Again, this is a risk business. We do trades that we take as little risk as we have to, right? Are we clear? Everybody good? Do you like to buy back the extras that you sell? No, I like to let them expire worthless. Now I have the YM the DIA trade open. I don't have the Russell yet. Okay, but again, I want to put more of these on. Again, this is a capital thing. Okay, if you have it on, great. It's doing well. If you don't have it on, it's okay too. Again, you got to think outside the box in this business. You see this slide every week because again, you got to think wider. Do you want to be a great option trader instead of all this bullshit and crap you read on the internet and see from all these imbeciles that know fucking nothing about options trading? Or do you want to continue in the same path? I'm teaching you stuff that nobody even fucking knows. You can't find the stuff that we do on the internet. Can you? Okay. Captain Condor blew up a couple weeks. Yeah. Again, like I said, this is what we do. Okay. We keep the risk under control. We always know exactly, on any given day, you can identify your exact amount of risk. But you have to learn to think outside the box. Okay. You have to learn to put yourself in the best position. Okay. You have to learn to be willing to navigate through the positions. Okay. But again, that's by thinking. Okay. Again, we do things that nobody else even fathoms what we do. And they're simple. They're not complicated. All right. Not only the Q trade, Netflix earnings trade, and JP Morgan earnings trade. Okay. Now again, you're talking about $8,000 worth of debit to start with. Obviously, if you don't have the capital, then you can't do them all. But these trades do take capital, but to get that position of very minimal risk with unlimited potential profit, that's how you do it. That's how we do it. Any questions? Okay. Do company or index trades tend to be more profitable? It depends. There's not an answer. Again, you're asking for questions that there are no answers to. Certainly, one of the biggest trades you ever made was on Oracle. We made over 10,000. Okay, on a one lot. Okay, so again, there's no answer that I could give you, which would be I could give you with confidence. Okay, and we just play them as they are, and sometimes we hit it big, but we're always grinding. We're always protecting. Okay, because it's all about the bankroll. I don't guess. It's not what I do. I can't answer. The best trade, the best grind trade day to day is the indexes because it's every day. But some of the bigger winners are going to be because of earnings or something like that. So, all right, sports fans, Happy New Year. Welcome back. I'll see some of you in Florida next week. And of course, we'll be back next Saturday. Have a great weekend, everybody. Enjoy.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.